I don't believe that there's a template of how to run an agency, but that's not to say that when I go and start looking at an agency, I don't try and apply some logic to how I want to see those numbers. And what that often looks at is a P&L and some timesheet reporting, because ultimately those two things together make up, either they support what I'm seeing or they don't. And if they don't, I need to understand why that is. And that then comes down to, it could be that someone has set up a system wrong to track utilization wrong, and therefore it's not actually giving you anything to do with the numbers that you actually want to look at.
Welcome to the Agency Profit Podcast, a show dedicated to going deep space on agency operations, which is just as nerdy as it sounds. I'm your host, Marcel I'm the CEO of Parakeeto, a firm that helps digital and creative agencies measure and improve their profitability. Join me as I interview some of the smartest thought leaders and agency owners in our space and go deep into operations, metrics, and all the other things you need to get right so you can spend less time worrying about operations and more time executing on your vision. Hello, everyone, and welcome back to the Agency Profit Podcast. I am pleased today to be joined by an internet friend of mine, a person that I've been following and engaging with on LinkedIn for a very long time. He describes himself as a FinOps guy specializing in agencies. This is what I have on the bio. His name is Rich Brett. I've been a fan of his content on LinkedIn for a long time, all things financial operations for agencies. And we're here today to talk about a really nerdy subject. We haven't gotten full nerd mode on the podcast in a little while, so I'm excited about this. We're going to talk about revenue recognition today. So Rich, thank you for making the time to be with us today.
Well, thanks for having me on. It's been a long time coming, I think.
Yeah, I would agree. I'm surprised we went this long without making this happen. And all it took was, I think, a cheeky LinkedIn DM, some kind of joke about having a friend of yours on the show before you. And I said, oh yeah, you're right. You haven't been on the show. Why don't you come on and we'll have a chat?
That was it. We won't mention that person's name though.
No, we'll keep that a secret. So real quick, I've given everybody a little high level on what you do, FinOps, but in your own words, what do you do and who do you serve?
So my background is in finance, so a senior management accountant, and worked at a big agency called We Are Social about 7 years ago. I got into the finance and operations side. It started to realize that it's not just about management accounts. It's like, well, how do we get those numbers? How can we make them better? And suddenly you start dipping into operations side of things. Had a couple of kids, decided to leave that business because it got a bit too big, and moved down to what you guys call the burbs or the sticks or the boonies, I think. So the middle of nowhere. And started working for a smaller business and did more head of finance stuff, more operations, got more involved again, even further into like project management and understanding a bit more about that. And then after 3 years, I decided after a bit of COVID that there's a gap, and that's a gap between non-exec directors, bookkeepers, and just finance people, and thought, there's someone here who has to try and join these dots a bit better, that smaller firms can't hire someone, they can't hire an FD because they're not going to do the expenses. They hire a finance manager, they're not going to be able to help them with strategy. So I sort of put myself right in the middle of that. So that's what I'm doing now. Work for between 12 and 15 agencies a month, varying from half a day up to 4 days, 500,000 to 10 million, but just trying to get guys to connect the numbers a bit better so that when you look at a number at month end, it makes sense and that it fits with the other metrics that you'll be looking at or timesheets. But ultimately, look forward. Like, how can we look forward? Because you can't change what's already happened. You want to try and change what's coming. And that's pretty much my main goal when I work with clients and owners, is start thinking forwards rather than backwards.
Yeah. And so it's interesting because we're kind of in a similar space. We're using slightly different language to describe it. You use the language of FinOps, or financial operations, to use the non-abbreviated term. So, before we get into the topic of revenue recognition, which of course is an important factor within this umbrella of FinOps, what is financial operations? How would you describe that to the layman that's listening?
God, it's really hard. And I don't think it really exists that much. It's quite a new term. I didn't come up with it, and I'm not sure who did. But for me, it's that kind of look at the Venn diagram of finance and ops. It's where those two bits join in the middle. And what that means is that often you have a finance person who just puts numbers together, and you have an ops person who's sort of doing a bit of delivery. So, but they're never really joined to the point. But actually, those finance numbers are dictated by what's happening in the rest of the business. And if you're not involved in understanding what's happening there, when you come to look at your numbers, it won't make much sense. And something like a rate card is a really good example of that. There's operations elements to how your rate card is put together. It's got utilization targets, it's got recovery targets, it's got an understanding about how billable someone could be or where they were. If you just completely discount that information and just go purely on, I'm building a rate card based on staff costs, what I think, then it's not going to work. But then the other side of that is once you've done that data, you then need to give it to the company and the operations and the delivery guys so they understand what levers you've used. Because if you set a rate card based on someone at 80% utilization, if actually they think that it should be 70, then suddenly we're not going to be making the margin we thought on that 80% rate card because everyone's now only working 70% of their time on client work rather than 80%. So it's kind of trying to make sure you join those dots and go, well, before you do that, have we considered how that might work in the system, or where are we going to get that data from to tell us that, or why are we doing it that way, rather than just being purely finance or operations. It's trying to get the two things together.
Yeah. It's funny. We recently wrote a piece about the siloed agencies sort of being like the model of the past, and our point of view being that like you have to take a more integrated approach into the future, where to your point, it's like a decision about how to recognize revenue, for example. That is like an inherently operational decision in a way. And we'll talk more about that. And I think that's the thing that people get a little overwhelmed by is there's a ton of little nuanced questions about every single metric. And if you change the answer to one of those questions for one of those metrics, you often now have to go reevaluate all of those questions for all of the other metrics in order to get to a system that is actually consistent across all of the different vectors. And that's a really hard thing to accomplish. And I'm glad that there's more people out there trying to solve this problem, because what we also know, and I'm sure that this has been your experience, every agency is the same in some ways and is completely different in all kinds of other nuanced ways. And so you also need to be able to work with those nuances and adapt it to that context.
Yeah, and I think the thing to be aware of is I don't believe that there's a template of how to run an agency, but that's not to say that when I go and start looking at an agency, I don't try and apply some logic to how I want to see those numbers. And what that often looks at is a P&L and some timesheet reporting, because ultimately those two things together make up either they support what I'm seeing or they don't. And if they don't, I need to understand why that is. And that then comes down to, it could be that someone has set up a system wrong to track utilization wrong, and therefore it's not actually giving you anything to do with the numbers that you actually want to look at. And I think too often than not in agencies, people are just doing the thing they need to do. But if you get to the people early enough so they understand how an agency actually makes money, they can then see what decisions they make might impact that. And I just don't think that's close enough if you're a finance person who's just doing age receivables, age payables, and putting a month-end pack and then trying to put a narrative together against variances, against a budget. And a budget, again, is another operational piece for me. Like, it's not just up to a finance person to dictate what those numbers are going to be. The whole business needs to be considered. That doesn't mean you have to talk to every single person at every level, but you need to make sure when you say, this is how much we're going to spend on marketing, has someone gone, but why? And is that the right place to put it? And that's not pure ops, but it is that operation of delivery and the operations of a business. So I think that's where it becomes really important. And it just becomes a much more of a collaborative financial number that's just presented or collected by a finance person.
So we could spend ample amounts of time talking about this broader subject, but there is a point of passion for both of us here that I think is important for us to get into today, which is revenue recognition, or RevRec as we refer to it. So let's start with, what is revenue recognition, and why is it important for those that maybe are not quite sure what we're talking about here?
So, I mean, a very simple one-liner, it's recognizing revenue based on delivery of work rather than when you invoice or when you get paid or a phase of an invoice or a project. So at each month or over a time period, we sold 100 grand, have we done 100 grand's worth of work? If we haven't, then we can't recognize that full amount. And I think that's the key part of it. And you can go into real detail about how you do that, but ultimately keep that basis of, have we done the work? Yes or no? And how much have we done? And the benefit is, it just means that when you're looking at metrics like utilization, recovery, your P&L actually it means something, because if you do it based on an invoice, then it's not going to necessarily marry up to all your other reporting. It could be showing your company in a really good light, or it could be doing it in a really bad light. And I use a pretty common example that most of my clients will be fed up of hearing is, if you win a retainer for 1.2 million on the 31st of December and you invoice it on the 31st of December, but all of it's going to be delivered. If you do it based on the invoice, you've just got 1.2 million for the last day of the year, but you're doing all the work the following year. That year will look great. The next year you did all the work will look terrible. Now that's also an extreme example, but that's kind of the approach to take, is if we haven't done the work, we shouldn't be recognized.
Okay. So there's a couple of important things to lay out here, I think, to frame up this conversation. So the first is that this is like a concept that is really applicable to this difference between cash and accrual-based accounting. So I think a lot of people are familiar with this distinction. Cash-based accounting, we look at when cash goes in and out of our business, and all of our bookkeeping and accounting is based on that. So the client paid us $100,000 and it hit our bank account this month, then we recognize that revenue this month. We spent $50,000 on this white label partner the next month, then the $50,000 go next month. So that's the cash-based view. Most people start there. I think the conventional knowledge is at some point as you start to scale, you should switch to accrual accounting. Now, here's where the nuance becomes really important. Most people think, oh, I went to my accountant, I said I want to start doing accrual. They go into this black box and do some things and black magic, and then they come out and they show me a new set of financial reports that look slightly different than my old ones. They say, we're doing accrual now, 2 thumbs up. You are now like, welcome to the upper echelon of entrepreneurship. Now, what doesn't get discussed is, how are you deciding how to accrue revenue, right? So to speak to what you just shared there, the difference with accrual revenue is we're not counting revenue based on when we collect the cash. We're counting revenue based on some other way of accounting for it. And I think the important nuance here that we should discuss before we get too deep into this is how you might choose to do that will change based on your incentives as either a tax accountant, a GAAP accountant, or a management accountant. And I think the two of us are in the world of management accounting. And so our incentive is to make it as accurate as possible relative to the reality of what the business is doing. So as a manager, you can understand what is really happening in my business. Whereas, for example, a tax accountant, their incentive is to say, how do we make it look like you made as little money as possible in this tax period? And so both of those accountants might tell you, I'm doing accrual accounting, but they might look completely different. And that's why. So with all of that in mind, we're talking about the management lens. What are some of the mistakes that people make when it comes to deciding how to recognize revenue under this accrual framework that leads to challenges?
I mean, the simplest one, and I think this is generally across all agency owners about everything, is they overcomplicate it. Is to keep it simple. Like, I think that's the main thing, is it doesn't have to be perfect. Even like the most incredible finance team with 7 or 8 people working across it and speaking to people every day will not get it right, because there's so many different variables at play that it's impossible to say this is exactly right. So I think you just need to make sure you've got a consistent view and that you understand what things you could look at to sort of almost sense check, does this feel right? I think that for me becomes the main thing, is I would be asking the person closest to that project or that number, does this feel right, when you then look at timesheets or when you look at something else that might just sort of, or a freelancer invoice or something like that. So I think that's the main thing. I think it's also to really bear in mind, number 2 is we're only talking about fee earned revenue here. We're not talking about full budget turnover, where it's you get £1 million and 900,000 is going straight out the door for media spend. Like, we're talking about the 100K there, because what we want to try and do is that revenue needs to match up with the cost of staff in that month or that period as well. If you start doing it with media, you're getting into a massive mess. And actually, what I would do with that is extract that out, defer it. I know that means putting it into the balance sheet and forgetting about it until we need it. And then you bring it in when the cost comes in. That's the same for any invoices. For me, like, if you start work before you invoice, you're going to accrue it. If you invoice before you start it, you're going to defer it. And this is up to your accountants to figure it out. But ultimately, it's that if we've started it and we've invoiced the whole thing, we're just going to draw down on that fee earned element. But you must only be the fee earned. And that's really important, because otherwise your numbers will just still be all over the place. And what you kind of want to see is in theory, as revenue goes up, your staff costs should go alongside it. Not like for like, but that sort of scale should go up with it, because in theory, most of the time in agency world, you need more people to deliver more work. So therefore, staff costs should go up in line with revenue to an extent, but that should go up quicker with revenue because you're making margin on the rate on the staff cost.
Okay. So to circle this a little bit, and then we'll get into tactics, the key issue that we both see constantly is we move to accrual, and then the methodology for earning revenue doesn't actually align to when the work is being done. The most common way is the accountant just says, oh, they just basically flip a little switch inside of QuickBooks that says use the invoice date to recognize revenue as opposed to the cash. And so the problem with that is, to your point, oftentimes the invoice date is not at all correlated to when we are getting the work done. And what we end up with, in my opinion, is actually worse than cash-based accounting, because it's equally inaccurate, but it's far less clear and simple to understand what's going on. So you just end up with like a shittier version of cash accounting, because there's no nuanced thinking that goes into the methodology for actually earning revenue. And then you end up with the same problem that cash accounting creates, which is you look at your P&L one month and you're like, oh my God, we're so profitable. We have so much money. We're doing amazing. The next month you're like, oh my God, how did we lose $100,000? The following month you're doing amazing again. And in order to get any visibility from your finances, you have to crop out to these large time increments, which inherently starts to smooth things out. And even then there's issues. And so the goal here is to say, how do we recognize our revenue in a way that is accurate and that tracks, to your point, to our largest expense, which is going to be staff costs, which we incur as we get the work done. Now, the question becomes, how in practice do we do that? I've got kind of 4 frameworks that I like, but I'd love your take on kind of what is a better way of approaching this than just arbitrarily using invoice dates.
I think the first thing to do is you take an example of 100,000. Let's just say it's all fee earned. If you know roughly how that's going to be, you could start, your forecast should say it's going to be 20% month 1, 40% month 2, 20% month 3, and I think I've got 20% left month 4. Like, that should just be a basic principle. And what that should do is align with your resourcing. So if you're doing resourcing, you should see similar bumps in your resourcing around, well, yeah, 20% of my time is booked in month 1, 40% of month 2. So that's a good principle to take. And you can just do that, because as long as that's kind of aligned with what you're resourcing, you should then see timesheets matching up to those numbers as well, in terms of, yeah, there's more effort in month 2 compared to month 1 and compared to month 3. So that's quite a good way of doing it as a sort of like base view. And especially if you're an owner-led agency where you're not as close to it, you could just take the assumption of like, it's a 3-month project, let's split it 3 ways. It'll all balance out in the end. But if you've got a few more people, you really want your project manager or your client services person who's leading the project to tell you. And basically what you'd say to them is say, right, this month, how much of the work are you going to deliver for this £100,000 project? And one of the questions I will often ask is, if the client came to you at the end of this month and said, look, thanks very much, we're going to just stop the project, but we'll pay you for everything that you've done up to this point, how much do we owe you? Now, that's not perfect, but that kind of gives you a sense of, we might have actually underserviced a bit but delivered more, or we might have overserviced, therefore we haven't delivered quite as much, but we've done these 4 or 5 things, so we can charge them for that. So that's the approach I like to take. And then you then kind of compare that with timesheets times by the rate card that you're charging for those hours. And that's what recovery effectively gives you that percentage. And ideally they should match up, but they don't, because value pricing kills that. Sell something for 100 grand and it's only 10 hours of work versus sell something for 100 grand and it's 100 hours of work. Timesheets don't show that. But that's where, if you get someone to make that call, it's kind of the best, safest route to do it, is to say, no, we've only done a third of this, so let's only book a third of it. And then you can then manipulate the next few months and say, well, let's just move these other things around. But ideally, it should always line up with resourcing.
So we have a very similar view on this, in that I've seen, so to take a step back, the fundamental idea here is that when we're recognizing revenue, that's based on essentially this concept of what percentage of this work is complete. And then you get into, in project management, all of the different methodologies for determining that. And I think looking at like how people do cost performance indexing, and like that's where you start to get into a lot of the methodologies for determining percent complete. And there's essentially 4 of them, right? The first is time versus timeline. So for example, we're 2 weeks into a 4-week project, therefore we are 50% done, right? So that is a model All models are imperfect, but they're useful. So that's a model that's maybe not 100% accurate, but for some types of projects that do earn their revenue very linearly, that might be a really good methodology for you to use to arrive at that thing. The second would be hours versus budget, which you've also mentioned for the types of work that correlate really well to time invested in the project via timesheets. That could also be a directionally accurate methodology, but it has drawbacks. The third is kind of a little bit abstracted from that. It would be, I would call it like a burn down chart. So if you were in like an agile development team, you might use your burn down chart or the development, the story points, or maybe the number of tasks checked off relative to the list of tasks. So it's a little bit abstracted. The fourth one is kind of what you had mentioned, using essentially some initial forecast or resource plan as the basis for that. And there's kind of a fifth one, which is sort of the project manager putting their thumb in the air and probably using a little bit of all of those things and just saying, 40%. And in most organizations, I've ended up landing at the conclusion that fifth option is usually the most appropriate actually for them. Even though it feels like it's the least scientific, it tends to be the easiest to maintain and the most accurate, and allows for the ability to kind of make those nuanced adjustments across the different types of work that are going on, often which often kind of necessitate a slightly different lens on those methodologies. So that's a lot of me talking. I guess the question to you, Rich, is like, are there any other methodologies that you've seen or experimented with clients that don't fall into those buckets?
Not really. And I think that's where I normally land, is that fifth one. Because if you trust your team and your client services or PMs are closest to the project, if they don't know what that is, then you've got a bigger problem. That is, the people who are delivering a project don't even know where the project is. And therefore, that's not correct. And I think that's where you then would bring in what we talk about in monthly reporting, is if you're doing revenue recognition and you're saying, no, we've done 15 grand worth of work this month, and then I look at timesheets and I see 30 grand, that's instantly raising an alarm bell for me of like, well, hold up. How come we've done £30,000 worth of work in terms of timesheets, but I've got 15,000 in forecast? That's me then going back to that team and saying, can you explain this? They might go, whoops, yeah, you're right. We did way more than I thought we did. We should book 30. Win for the finance team. Suddenly we've got an extra 15 grand of revenue to book in this month. But also flag, how did they not know that? So this is where it becomes FinOps is, I now need to speak to the resource manager and the client services guys to understand, how did we not know that we'd done 30 grand worth of work? They thought we'd only done 15. Or they say, do you know what, that's over service. We screwed up. We can't book it, but we just had to do it. Again, that's bad news, but the worst news is what we're going to do about that. So it then comes down to almost like root cause of, okay, you're telling me that, but what am I going to do about it now? And what is the business going to do about it? If you don't do that and you're looking at an invoice, none of that data means anything until you finish the project. And by that point, it's too late, because ultimately you want to know where you are, because you want to see where you're going. And if suddenly you need to do £60,000 of work next month, what if you haven't got the resource for it? So then you start getting really good at it. You're comparing resource time versus the forecast, because if you see £30,000 booked and £60,000 worth of revenue in the forecast, you've got a new problem. How are we going to deliver £60,000 worth of work next month? I need to go and speak to the traffic manager. We might need to get some freelancers in. That's more staff cost. So really, it's about really making sure that when you see that number, you're thinking, is that possible? Because for me, if I see £60,000 and £30,000 booked, I'm thinking something's wrong here. So you've either got your number wrong, or we need to book some more resource. But either way, something has to happen between one of those two numbers.
Do you want some free resources to help you measure and improve your profitability? If you do, then I want to tell you about our agency profitability toolkit, which you can grab absolutely free in the show notes or by heading to parakeeto.com/toolkit. It's packed with training videos, cheat sheets, templates, and all kinds of other great resources to help you start measuring and improving the essential metrics that are going to drive better profitability in your business. And it's helped thousands of other agencies around the world do the same. So I want to encourage you to go and grab a copy of that. And if you'd rather get in the fast lane and just have our team of experts guide you through the process of measuring and improving your profitability, then I want to encourage you to apply for a consultation at parakeeto.com. And with that, I want to thank you again for tuning in. I hope you enjoy the episode, and I'll let you get back to it. This is what I love about this lens on revenue recognition, of really getting down to the first principles of saying this should be based on percent complete, because it creates that intrinsic link between operations and, to your point, forces this level of relationship, clarity, conversation between finance and operations. And that is kind of institutionalized in the way that these numbers are actually calculated and measured and the impact that it has on finances. And so I really love that feature of having it structured this way. Now, with that in mind, I think there's some challenges that people run into this. The first of which is if they're working with a standard, let's say, accounting or bookkeeping firm, they'll often get pushback because this is more work than just using the invoice tool. So let's start there. What should people do if they go to their accounting team and they're like, hey, here's a podcast with these two guys that you're probably not going to like, telling you to do your job in a way that requires more work? How does one navigate that conversation?
Get better accountants. No, I'm joking. Of course, that's not the right answer.
Shameless plug. Yeah.
I
Links
think,
in the show note to Rich's website.
Yeah, I'm not a proper accountant either. I think again, you keep it simple and you say, look, you work with them as well. I had a call with a new client the other week, and they said, yeah, we're doing this for another client. Maybe we can use a similar template, because ultimately what you're saying is we've sold 100,000. Can we split it? So when you see the invoice, can you make sure that you don't take more than the 10K that we're recognizing? We're going to tell you at the end of the month what that is. And it could just be one number, right? It doesn't have to be broken out into project and project and project. You can use your template to do that. So what I'll try and do is set up a forecast sheet that will collect that data. And because I'm actually doing it for a lot of my clients, I have a document that I use, which basically says, I want to take £10,000 of revenue. I've invoiced 20. Therefore, I'm going to put 10,000 until next month in the balance sheet to worry about. Now, a good bookkeeper would just say, you give me the information and I'll figure out how to do it. But the more complex it gets, it is a little bit harder, but that normally comes with size. And that's where you then probably need to start having a finance manager or someone who's a bit closer to it. But just keep it simple, because a bookkeeper should be able to say, we've invoiced £100,000 this month. We only want to book 50. So put 50 into the balance sheet until next month, and then we'll release it down. And if they don't do that, you have to try and figure out a way of working with them, or get someone to help you come up with a system to do that. But it shouldn't be that complicated if you just have a simple process that works. And you probably don't need to do it monthly. You could do it quarterly. I'd advise it to be monthly, because if you want to look at a board meeting numbers and look at your finances, if you're waiting 3 months, all sorts of stuff could happen in that 3 months. And really, this goal of this is not the historic part, it's the future looking part of, but what does that revenue recognition look like going forward? So really the bookkeeper's part is quite small. It's the bit that looking forward is the bigger bit, and that's for the business. And that's often harder, because that's about people understanding what we're trying to do and get away from that. I've invoiced, so we've sold it and we've won it. We've got £1 million. It's like, we haven't even delivered a pound of it yet. And that's the bit that is the harder bit to get right, is that mindset change internally.
Now, I think there's a whole bunch of other challenges that come with this. We've talked about a few of them. And the nice thing is a lot of these are just like, they're challenges because they're exposing something that needs to be fixed, right? So then the next thing is, okay, we've gotten our bookkeeper or accountant to agree to do all these journal entries for us, or whatever mechanism they're going to use. Now the question is, we're actually realizing we're not very good at figuring out how far along we are in these projects, right? So again, you kind of mentioned that earlier, which is, well, that's a problem that probably needs to be fixed. That's a critical sign of agency health not being great. What's your approach to addressing that issue when you see it come up?
And go to source and say, right, what's the source data? How many blocks of time did we sell on this person? How many blocks of time did we sell on this person? How many hours have they done? Let's understand what we've actually sold. What's the source of truth we're working from? And if we can then not figure that out, then there's really an issue around that the client services team or the PMs aren't as close to the project as they should be. We're not asking them to look at timesheets that really. We're saying, how far through this are we? And if they don't know that, you've then got to the point of, if you don't know how far through a project you are, you're probably not close enough to it. So actually you need to get closer. We'll support you by trying to get the system that does timesheets and resourcing to be more accurate. But ultimately, do you need to have a check-in each week that says to your team, have we done this and this? And almost like you say, just tick it off and say, yeah, we've done that bit. That was £5,000. We've done that bit. That's 10 grand. That's 15. Oh, we're halfway through that 5. That's 17 and a half. Like, try and keep it as simple as you can, but make sure there's an awareness of, have we done it? Not have we invoiced it? Our timesheet's showing it. And that's really about communication. And I think that's the bit that when we were doing it at We Are Social back in the day, we had a finance business partner with each client team. And they'd sit with them every week and go, look, I'm looking at your timesheets. I'm looking at your resource. These are my variances. Tell me what's going on in the project. And that's a luxury when you're 150 people and you've got a big finance team. But when it's smaller, it's the same thing. There's less of that, it's smaller numbers, but it's ultimately saying, tell me how far we are through it. And if you don't know, you need to figure out how you can figure that out without having to run loads of reports. Because this shouldn't be a big report thing. It should just be, we've done a third of the deliverables, so therefore we're booking a third of the project. Simple.
Yep. Now, this leads to the next one, right? So let's say you get to that point, you might discover that the issue is that there aren't clear assumptions being created at the inception of the project scope and price to begin with. And sometimes this is just, I mean, we see this like, we just never really thought about that a whole lot. We just kind of been selling stuff and then doing it. And we ask the client for an amount of money that we think makes sense. And then sometimes there's like a mindset around, and I found value-based pricing to be the most problematic of the pricing models for this, where people start doing value-based pricing and then all of a sudden they kind of adopt this mindset of like, oh, there's now no longer any purpose to understanding the scope, understanding how we're like internally, there's no point in having a set of ideas around what the value of each deliverable is, what the deliverables even are, what the scope of those are, what we plan to invest in those, what the cost basis is. And so those ideas just aren't being codified internally. So that I think is kind of the next step, right? If you find that an agency is just not really actually clear on fundamental scope and price structures, what are some of the kind of key components to dig into there?
I mean, value pricing, I would still have a quote that agreed back to something that said, these 4 deliverables, one's worth 10, one's worth 20, one's worth 20, broken out by role or broken out somehow to see that I've got something that agrees back to how I got to that number. Now, that might be that it's a £10,000 a day rate because you're selling it at that value. But at least we then know that we've got to do that day to then get that 10,000 because that's a deliverable. So you kind of, regardless of value pricing or T&M retainer or just a normal project that is just sold on, roughly we're going to deliver this for this many hours, we don't know. You still have to have a source of truth which says this is what we agreed we would deliver to you, and this is roughly how internally we think it's priced at and who's going to have to do it. Because for me, every statement of work should have a resource plan. And if that is £10,000 divided by 10 hours, or whether it's £10,000 divided by 100 hours, those resources should still be in a system somewhere, and we should know when those people are doing that work. So for me, it always comes back to, and this is the case whenever I would look at something, is what did we sell? And how much did we sell it for? Because that is the key point of what we're looking at, is if that's what we sold, we need to know how far through what we sold is. And if we've done nothing but spent 10,000 hours on it, we've got a big problem because we spent 10,000 hours doing nothing. And so really that's the key for me.
There's a really big idea here that I think is important, right? And it's the distinction between external and internal communication and external and internal documentation. I found that in many firms, there is this sort of like arbitrary constraint that is the document that's used to show the agreement to the client has to be exactly the same document that we use internally to document our assumptions. And I don't know where this comes from, but like separating that is such an important thing, because the goal internally is to tell the truth about the scope of the engagement. The goal externally is to get paid as much as we can for that scope of work and have the highest possible margin. It is not only common, but likely that the way you have to describe the scope of the engagement is going to be materially different between those two things. And what it also tends to do is it breaks the link that is sometimes problematic in the pricing process, which is that the team feels that the only way that they can decrease a price is by lowering the number of hours, even though that hasn't actually occurred, because they just don't feel that, or the mechanism to lower the rate or to discount it, which is objectively what's happening in that situation, is not available to them. So then you end up with a flawed resource plan. You end up lying to your internal team. There's zero benefit to that. So there's like a nuance here, which is if you're running into this issue, the first thing I would look at is there a clear separation between what is the documentation that exists internally that should be geared towards truth, and what is the documentation that is external that is geared towards selling to the client, presenting to the client in a way that aligns to however that conversation is happening.
And a lot of agencies are guilty of this, which is they've sold 10 hours, but they have to do 30, but they just book the 10. So therefore you think, oh yeah, we've just done 10 hours because they put the other 20 to non-billable, because we don't want to see that. But that's where your reporting starts to sit, because then you suddenly see a big increase on non-billable on this client. You go, what's that? They're like, oh, that's the stuff that we actually had to do to deliver that 10 hours. Oh, so actually it's 30 hours, and actually our recovery is like 33% because we spent way more time on it. And I think for me, that's really really trying to be really clear about what billable utilization is. And I know it's going into a separate subject, but billable utilization does ladder up to RevRec, which is, for me, billable utilization is work that a client should be paying for whether or not they are. And that is about, if you overservice because you had to get a deliverable over the line, you overservice, but you can't book more revenue. But it doesn't mean that next time when you sell it, you don't try to increase the budget, because you now know it actually takes longer to do it, or you can do it at the same price because you've learned how not to do it wrong, or how to do it not wrong, one of those things. But it all ladders up back to recovery, that if you're looking in your board meeting at invoice or cash-based revenue and utilization and recovery, none of it makes sense, because your profit will just be showing you invoice something. Your utilization will show everyone being busy. And the amount of times I've heard people say, how can everyone be busy but we're making no profit? You look at their P&L, they're not doing RevRec. Or of any kind. It's just purely, we didn't invoice anything this month. And one of my clients used to be terrible at invoicing. And she suddenly, if she won't watch this, but she might do. She'd just suddenly do a big chunk of it in 1 month. And that month looks incredible. But the utilization and the staff costs stay the same. But therefore, you've got to try and get those two dots to join. And that is FinOps, is the P&L says this, but is it supported by what we see here? And most of the time, people try and hide it in non-billable, or they try and hide it in internal. But you can't do that with RevRec, because you're telling me this is the work we've done. How can we do that work if no one's been working on it?
And this is the magic of getting this dialed in. Like, for, when we're working with clients, they're never surprised by their P&L ever again, because you knew before the month even started what your utilization was going to be. And well, there's kind of like these two levels. First, you look at it on a financial basis. What are we going to spend on delivery? What are we going to spend on overhead? How much revenue do we expect to earn this quarter or this month or this week? And as long as you're hitting your financial targets, that's great. And then underneath that, you have the operational insight. And there's a million possible combinations. You could have been below your utilization, but above your average billable rate target, which means you got it all done in less time. That's a great outcome. You could be above utilization and below your average billable rate, which means it took you more time, but you still earned the right amount of revenue. That's an okay outcome, not as good. Or you could be right on target for both. And so you get so much more insight from this, and you're not surprised. You're not looking at your P&L being like, oh shit, I had no idea. Like you knew this ahead of time because these things are dialed in. To your point, whole other episode on utilization, right? Is it a delivery hour? Is it a billable hour? Like, I've started just calling those different things, because the word billable I find is kind of problematic, because it implies that it was billed to the client when, to your point, maybe it wasn't. And so this stuff gets, I think, really fun and exciting. But to most people, it just gets really overwhelming. And so I think the message is, you don't have to figure this all out on your own. There are people that have systems that you can install. And so I'll just leave it at that. You all know what you need to do next. Go to the show notes. And
I would say one thing, when you get good at it and you start forecasting, what we would always be looking at is 2 to 3 months ahead. We'd see that staff ratio, cost of staff against the revenue recognized amount. See that starting to go up at 72%. You're like, wait a second, this is getting too high. Okay, we've got a couple of projects that aren't quite secured. That's why that's not it. Or no, we need to go and win some new work. Or if it goes down below 55, 52%, wait a second, we've got too much work. We need more people. And therefore, you're always ahead of the game. You can do more about what's coming than you can about this month. No one is doing anything about March right now. No one is doing much about April right now. You've got to really be thinking about, what can we do to change what's happening next month? Because this month it's too late. And I think that's where with RevRec, if it's about invoicing, that's just about raising more invoices. That doesn't solve any of your problems around how profitable we are. You're just raising more invoices and there's more cash in the bank. But eventually it's going to drain down. And that's the other thing, is getting those two things to tie together. You need to do both. You need to do a cash flow forecast and a P&L forecast. They're different things, but they kind of need to be aligned. And that's, you don't just give up on one of them. You have to still do both. And that obviously is more nuance and more complication. But again, speak to your bookkeeper, speak to your advisor, speak to your accountant. They'll have something that will be simple. And then you can just iterate and try and make it as good as possible.
Well, Rich, we can talk for a very long time, but unfortunately we don't have a very long time. So for those that want to follow you and what it is that you're talking about on the internet, where should we send them in the show notes?
Well, I'm on LinkedIn. I think you're very kind and said that I'm consistently abrasive on LinkedIn, but you can always follow me on LinkedIn. I try and have a mix of useful stuff and just basically bad-mouthing LinkedIn and the people on it. So if you like those two things, you'll enjoy it. But if you don't like those two things, then you can follow someone else.
Amazing. So we'll leave a link to Rich's LinkedIn. I do recommend the follow. You'll see me in the comments every now and again as well, chopping it up with Rich. And with all of that, I want to thank you for making the time to be on the show today, Rich. Always a pleasure to chat with you.
Thanks for having me on. Cheers, Marcel.
Hey, thanks so much for tuning in to today's episode. I hope you enjoyed it. And if you've ever found yourself thinking, man, I get so much value from this podcast, I wish there was something I could do to return the favor. Well, today's your lucky day because you can leave us a review wherever you're listening to this, and it is incredibly helpful. Of course, if you haven't grabbed a free copy of the Agency Profit Toolkit, go and get that. It's got tons of free resources to help you improve your profitability. If you're looking to get in the fast lane and get help from experts to improve your profitability and measure your most important metrics, then apply for a consultation at Parakeeto.com. We'd love to chat with you and figure out how we can help. With all of that, thank you so much for being a listener, and we will see you on the next episode.